I think we can start. Good morning, everyone, and welcome to today's webinar on climate risk modeling made practical for macroeconomic decision making. I'm Tabo Potledi, and I'll be guiding you through the session. Here's what we have lined up for the next 45 minutes. We'll start with a quick introduction of Optimum Solution. Next, we'll look at typical MATLAB users in the financial services industry. Then we'll look at how to incorporate climate risk modeling in ongoing modeling, followed by a live simulation of DIGNAD showing how a natural disaster impacts GDP and debt, and how adaptation, investment, and concessional financing influence the results. And then finally, we'll look at how we can support your own use cases, and then we'll wrap up with a Q&A session where you can share your thoughts or ask about your own use cases. Optimum is a high-tech consultancy and engineering firm delivering data-driven and business-critical solutions. We specialize in artificial intelligence, model operations, as well as simulation engineering. And some highlights about us include that we have been in business for more than 30 years, developing technical solutions. Our team comprises of more than 30 engineers experienced in navigating complexity and blue sky thinking. And collectively, we've delivered more than 250 projects, both locally and internationally. So at Optimum Solutions, we are passionate about partnering with our clients to tackle complex business challenges and provide data-driven, evidence-based solutions. And we do this through our consulting services, where we collaborate with our clients and enable their teams to solve complex problems. And then as the sole authorized resellers of, I'm seeing a chat that's saying there's no audio. Is that the case for everyone?
I can hear my side.
Yeah, perhaps it's just your audio there. Um, but yeah, as the sole authorized resellers of MathWorks products, we also serve commercial entities, academic and research institutions, as well as startups and incubators with MATLAB and Simulink, along with other peripheral products. And we, in our consulting services, we also assist our clients with algorithmic with algorithms and software development, where we emphasize deploying production-ready solutions. And we provide these offerings across a wide range of industries, including banking and financial services, where our clients include central banks and commercial banks, as well as other financial technology institutions. So how do our financial services clients use MATLAB? Central banks and regulators use it for macroeconomic forecasting, stress testing, and scenario analysis for financial stability. They use it for system risk modeling as well as contagion analysis. Asset managers, hedge funds, and proprietary traders, on the other hand, use it for portfolio optimization, asset allocation, risk modeling, as well as Monte Carlo simulations, algorithmic trading, as well as quantitative strategies. Commercial banks, on the other end, use it for credit risk modeling, or calculating default probabilities, balance sheet and stress testing, as well as consumer finance modeling. Investment banks use it for valuation models, for option pricing, as well as derivative modeling, as well as market risk and high frequency trading. And then finally, insurance and insurers use it for actuarial risk modeling, as well as catastrophe modeling for natural disasters, as well as solvency and capital modeling. And a relevant macroeconomic model within the banking and financial services space is the quarterly projection model, which has now become a standard for many central banks. And the QPM is an analytical engine behind a central bank's monetary policy framework, helping policymakers forecast the economy, test policy options, as well as communicate their decisions in a very structured and credible way. And They use it mostly to produce baseline forecasts such as GDP, inflation, and so forth, as well as to conduct scenario analysis and policy simulations where maybe they are interested in seeing the effect of oil price shocks, but also they use it to support monetary policy as well as inflation reports. Please note that my colleagues will launch a quick poll in the chat just to understand at this stage the macroeconomic framework that your institution primarily use for forecasting and policy simulation. So please take a moment to respond to that poll and look out for further polls throughout the webinar. In addition to those aforementioned use cases, the QPM can also be used to serve as an anchor for other satellite models like climate risk models. And this integration can be achieved through one, extending and personalizing the current QPM framework by creating a natural disaster shock channel as an example. Secondly, it can be integrated through parameter calibration, such as using satellite model outputs. So this is where you would use your DIGNAD outputs to calibrate your current QPM outputs, for instance. And then finally, they can use it at least, or couple it with other modular frameworks, and these satellite models can be run in tandem with existing frameworks like the QPM, wherein the resulting macro paths out of the DIGNAD model, for instance, would be used as scenario inputs into QPM. So one such satellite, as I've briefly introduced, is the DIGNAD model. And before we get into the DIGNAD model, why should climate risk modeling even factor into policy analysis? And the answer is simply because natural disasters affect the economy, and they do this through a variety of channels, such as damages to private capital that results in less capital available for production. Damages to public capital is as a result of the disaster on the public infrastructure like roads and bridges and so forth, as well as temporary productivity loss that results as an impact of the disruption. Further to these channels, it can also the natural disasters can also affect the economy through a decline in the public investment efficiency, because it becomes more expensive to reconstruct public capital, as well as capacity constraints. And then finally, through a loss in credit worthiness, because lenders perceive it more that a country might default. And this is usually due to a downgrade in credit ratings. So DIGNAD itself stands for Debt Investment Growth and Natural Disasters, and it builds on the underlying framework of the debt investment growth model, and it is mostly used to simulate the effect of one-off climate disasters and to help with quantitative assessments and policy a scenario analysis of the macro fiscal effects of natural disasters and adaptation investment. DIGNAD is a dynamic general equilibrium model suitable for emerging markets and developing economies, and it was developed at the IMF. So the core of the model encompasses three blocks. Firstly, it's the private demand block, which contains households' consumption and saving decisions. And households are made up of savers and non-savers that earn income and domestic transfers, and they consume domestic and foreign goods. And in addition to this, savers also have faced with the decision of where to invest their capital. The second block is the private supply block, which contains firms' decisions on labor and capital demand. And this is made up of the tradable and non-tradable sector. and firm production requires labor, private capital, as well as public infrastructure, which can be in the form of standard or adaptation infrastructure. And then finally, you have the policy block, which collects a set of fiscal and debt instruments that covers, government investment plans as well as the financing. And the dynamic general equilibrium nature of DIGNAD is such that it ensures that these three blocks are interdependent and the macroeconomic outcomes are jointly determined by their interaction. Right. So the toolkit itself can be downloaded from the relevant IMF page. You can see the link on the screen, and you can download the toolkit, the user manual, as well as an accompanying presentation to get started. The toolkit combines an Excel-based front end and a back end that makes use of MATLAB as well as DIGNAD and CompEcon scripts and function. And the Excel interface contains three files: the input, run, and output files. And we'll look at those in the demo. And for the demo, we're going to look at, we're going to consider a hypothetical once in a 100-year flood that devastates, at least destroys 10% of Rwanda's capital stock. And what we're interested in is understanding the impact of investing in ex-ante adaptation on output growth as well as public debt. And we're going to consider three scenarios. The first scenario being the baseline where there is no adaptation infrastructure, and we're going to look at the effect of the flood hitting in 5 years. The second scenario will be the introduction of resilient infrastructure, and here we're going to look at a budget envelope of 1.5% of the GDP per year, financed through private financing and concessional borrowing for 5 consecutive years, leading to the shock. And then finally, scenario 3 will look at over and above the adaptation investment, the introduction of reforms like your PIMA type, which result in a 20% increase in your public investment efficiency, as well as catalyze green financing from private sector and other development partners, resulting in a further 1.5% GDP. So at this stage, I'm going to just switch what I'm sharing and move over to the toolkit itself. So this is what you would get when you download the relevant toolkit, as well as the user manual and accompanying presentation. The user manual, I should stress, is very detailed. So I do recommend that once you've downloaded this, you start off with the user manual. It gives you an introduction on DIGNAD, takes you through how to run it, what everything means, and so on. So then the DIGNAD toolkit comes zipped. So once you unzip it, you should end up with this folder, which contains 3 subfolders. The first being the e-packages folder, which essentially contains your CompEcon scripts as well as your DIGNAD model. Just this. And then you have an Excel output folder, which essentially is a container for your time series data that you will export from the model. And this, you can find further sub folders relating to the day that you ran the model. And then in the figures output, this is essentially for those variables that you've exported. You can also export their figures. So you have 2 types of figures. You have MATLAB figures, which open up in MATLAB. And then you also have PDF figures, right? So within the root folder, you will find further MATLAB scripts that facilitate at least the running of the toolkit. But what I want to draw your attention to is these two Excel files. So you have an input worksheet as well as a run from Excel worksheet. So the DIGNAD toolkit can be run either through the Excel interface, or if you're more familiar with MATLAB, you can also run it directly from MATLAB. So this is how the run from Excel spreadsheet looks like. It essentially is a macro-enabled spreadsheet that allows you to call and run the toolkit without even interacting with MATLAB code directly. And within this spreadsheet, you have 4 modules that you can run: the simulate, alignment, realism, as well as donor savings modules. And for the purposes of the demo, we'll mostly focus on the simulate. We'll just go over what the other modules do. Then, so this is essentially where you would run the module. But before you actually run the module, what you want to do is navigate to the input file, Excel file. I'll just minimize that. And essentially, this is a container for your modules as well as your parameter definitions, the scenarios, the financing options that you want to run, as well as setting up the graphs and output that you essentially want to export at the end. Starting off with the calibration worksheet. This allows you to calibrate the main parameters of the model and to define the steady state values of the key macroeconomic variables. So these have been segmented into these categories, beginning with the country specific parameters and moments. And these allow you to essentially calibrate the model, at least, and to your particular economy. And following that, you have parameters determining the main characteristics of standard and adaptation infrastructure. And these include parameters such as the depreciation rates of standard infrastructure to adaptation infrastructure. Then you have your fiscal adjustment parameters such as the share of public debt between commercial and domestic debt. And then finally, you have other structural parameters, and these are mostly parameters relating to the model itself. And then further to this segmentation, the parameters have also been color coded. You have green parameters, which, as I've mentioned, are typically based on information specific to your country. You also have these orange parameters, and these are similar to the green ones, but should only be essentially calibrated if available. You also then have your yellow parameters, and these are very features that are specific to adaptation infrastructure. And then finally, the blue parameters are essentially model specific and are for more advanced users. So yeah, that's what the calibration worksheet's purpose is to essentially calibrate all these parameters relating to your use case and specific economy. Following that is the exogenous series worksheet, and this allows you to specify the path of public infrastructure investment, grants, concessional debt, and terms of trade shock. And you have these for the 3 options, and you can see the scenarios that we will be considering there. And these allow you to essentially define these for up to 50 periods. And then following that, you have your scenario worksheet, which is essentially allows you to choose the combination of financing scenarios that you want over there. And that is whether the government closes the fiscal gap using either taxes or allows debt to deviate from its steady state value. And the specific options, financing options have been described there, and you can just essentially read that and choose whichever financing option you're interested in for your scenario. And then you also are able to choose which exogenous series from the exogenous series worksheet that you want to run in column F, right? And then the disasters work sheet essentially allows you to define the timing of the natural disaster, at least the shock that you want to introduce, and the damages that that shock induces, and how long it takes the government to rebuild the stock of public infrastructure. The graphs worksheet allows you to choose the type of variables that you want to plot, and you can select up to 16 variables, and you can define the number of periods that you want to block, define the structure of at least how you want those variables to be plotted, and yeah, the number of variables to be plotted. And yeah, you can, as I've said, you can specify up to 16 variables. And this is that worksheet is very similar to the XLS output, but for this is essentially defining which variables, at least the time series data that you want to export to Excel. Um, then in addition to these aforementioned worksheets, you also have additional module specific worksheets. You have your realism worksheet, which essentially allows you to analyze the sensitivity of the model output for different values of the disaster mitigation factor. You have the alignment module, which allows you to make the model match a user-defined trajectory of real GDP after a natural disaster. So if your particular economy is prone to natural disasters, you can use a previous trajectory of GDP to match it to your current model. And then finally, you have the donor savings worksheet or module, which essentially allows you to calculate the net savings or losses of donors from ex ante adaptation investments compared with investments in ex post reconstruction. And this is usually because donors face trade offs between investing before or after a disaster. So yeah, this is essentially the input Excel file where you will essentially define all your parameters, your scenarios, and your disaster. So for the purposes of the demo, the calibration parameters have been preset, but what you would do is go to like a particular worksheet and essentially start defining, for instance, in this exogenous sheet, you would want to define um, the path that matches your scenarios. And as we've said, for baseline one, we have no public adaptation infrastructure. So you can see that has been set to 0% of initial GDP. But for option 2 and option 3, we've introduced adaptation investment. So what you would do is come here and essentially just define that. In our case, we've um, agreed that we're going to invest for 5 years prior to the disaster. So this is where you would set it up essentially, and just set that. And in addition to that, we've also defined the path of grants and concessional debt as per our scenario definitions. And then you would also then go to your scenario sheet where you would define the financing options that you have. So for scenario one, we're going to choose all debt, which essentially allows public, domestic, and external commercial debt to cover the fiscal gap, in addition to the path of concessional debt and grants that you specified in your exogenous sheet. And for this financing option, you also need to define epsilon in the calibration sheet, which is essentially the split in terms of public debt between commercial and domestic debt, right? Then for financing 2 and 3, we're essentially just going to run it off the exogenous paths that we have defined. And for option 3, what we've introduced over and above the adaptation investment was that 20% increase in the public investment efficiency. And this is where essentially, so 50 essentially means steady state or baseline. And so what you would want to do is increase that to 70, right, for that additional 20%. And then in the disaster sheet, so we are going to introduce a natural disaster, a flood in our instance, in period 6 of the sort of like our exogenous path. So in period 6, that's when we'll introduce the natural disaster that correlates to 2027, and we're going to induce sort of like a 10% damages on the public capital and private capital. And then you also get to specify the recovery and completion dates of sort of like the reconstruction. And then the variables that we're interested in for the purposes of this demo will be real GDP, as well as total public debt. So this is essentially where you would select the variables that you're interested in. So these are pulled through into the XLS output worksheet, where it just looks that you've specified 2 variables to be plotted, and those variables are real GDP as well as total public debt. And all the other variables are then set to 0. So from here, you would then navigate to your run from Excel worksheet and essentially just run, press the simulate module, and this would call the relevant MATLAB files and models and essentially run in the background. So I've pre-run this for the demo, and what you'll see that essentially within the output for today's run, you will get essentially a model output. And how that looks is you will essentially get this time series data of those variables that you've selected in your input file in the graphs and XLS output. So you can see here we've plotted the deviation of real GDP from steady state, as well as the percentage of total public debt of GDP. And you have this for all your financing options and exogenous paths. And then finally, you would also get a figures output. Similarly, for the day that you ran it, you can essentially see the results that you've plotted. So at this stage, I'll just navigate back to, I'll just stop sharing and navigate back to the presentation. And we can look at the results. Wow. Excuse. Can they? And I'll just reshare presentation. It should be coming through any minute now. So essentially, this would be the figures that would be exported. And for our case, we've chosen real GDP deviation from standard state, as well as total public debt. And these charts essentially show how the output, which is the GDP and debt, respond to that temporary flood shock under the different scenarios that we've defined. Blue, the blue chart being the baseline scenario. The red is the adaptation, and then yellow is the adaptations and reforms. And we can see if we focus our attention on the real GDP as a percentage deviation from steady state, which is the left chart, that the initial impact happens in 2017, and we're seeing that the natural disaster causes a very sharp GDP contraction in all of our scenarios, at least in all of our cases. But we are seeing that the largest is in the baseline, which is around 7%, and smaller when adaptation investment is essentially introduced. And this essentially just shows that adaptation investment softens the immediate output loss, right? And then if we focus our attention to sort of like the recovery phase, so this is post 2027, post the disaster, we're seeing that the GDP recovers faster under the adaptation investment, so the yellow and the red. And this is due to like a stronger rebound, stressing that in resilient infrastructure and reforms do help restore productive capacity more quickly. But we can see that by 2040, so this is after 20 years, that GDP remains slightly below steady state, but much closer in the two adaptation scenarios than it is in the baseline scenario. And essentially what we can draw from this is that adaptation investment mitigates the output loss and accelerates recovery after a climate shock. And adding reforms on top of that further enhances long-term resilience and efficiency, right? And if we then focus our attention on the public debt chart on the right, here we're seeing again is that the evolution of debt as a share of percentage GDP under the same three scenarios. And here we're seeing that the debt rises drastically in all cases prior to the shock. And we are seeing that the largest increase is in the adaptation scenarios. And perhaps this is due to the fact that it's more expensive to construct resilient infrastructure than it is standard infrastructure. And what we see that after the recovery, which is sort of like after 2028, because for like a year, everything is almost normal, at least non-changing, is that adaptation and reforms has the slowest debt reduction, as reforms and investment take time to pay off. And the adaptation investment, which is the red line, essentially stabilizes sooner than the other three charts too. And then finally, what we're seeing is that the baseline scenario, that our debt falls way faster after the shock. But as we've seen in the GDP graph, that is at the cost of a weaker growth. And here we can draw that adaptation investment raises debt in the short term, but helps preserve GDP in the long term, and essentially reduce the long-term fiscal risk, as well as reforms make the path more sustainable in the long term, even if the initial debt impact is higher, right? So to wrap up, we have just demonstrated how you can start modeling key financial parameters such as GDP, debt, and inflation, and the economic impact of exogenous shocks such as climate change. And we've done this. We've seen how you can leverage the modeling and computational capabilities of MATLAB. However, MATLAB can be used for a whole lot more users. It can be used, at least leveraged, to build apps, web apps, and tools to pre-process and visualize data. You can use it to fit, simulate, and forecast complex macroeconomic scenarios using either univariate or multivariate econometric models. You can model and manage stress tests and prudential requirements and maintain orderly markets using machine learning capabilities. You can use it to scale, compute, and store data securely in the cloud and to integrate with your organization's enterprise technology infrastructure. And the key products that you would use for these use cases include general purpose toolboxes like your statistics and machine learning toolbox, and other finance specific toolbox such as the financial toolbox, econometrics toolbox, and financial instruments toolbox, amongst other toolboxes like instrumental toolboxes like the database toolbox that you can use to connect to your data sources, the MATLAB compiler toolbox that you can use to essentially compile the apps and web apps so that such that you democratize access to these models within your organizations. And finally, as Optimum Solutions, we can help you with technical support, on-site and in-person training, as well as expert and consulting services. And this brings us to the conclusion of our webinar. And I'll just open up the chat so that to questions. I don't know if there's been any questions that have come through in the chat that we might address. But yeah, if you have any questions, please feel free to just ask. If there are no questions, we can wrap the webinar up. But yeah, please feel free to reach out if you do have questions. All right. Yeah, I think we can leave it here. So thank you for attending the webinar. And yeah, I will look forward to maybe hearing from you if you're interested in climate risk modeling. And thank you to everyone.